Option trading is a type of investment strategy that allows traders to purchase the right but not the obligation to buy or sell an underlying asset at a specific price within a specific time period. This can be a useful tool for investors looking to hedge their portfolio or speculate on market movements. However, option trading can be complex and risky, so it's important for beginners to understand the basics before diving in. Types of options. There are two types of options: call options and put options. A call option gives the holder the right to buy an underlying asset at a specific price within a specific time period. A put option, on the other hand, gives the holder the right to sell an underlying asset at a specific price within a specific time period. Strike price and expiration date. When purchasing an option, traders must choose a strike price and an expiration date. The strike price is the price at which the underlying asset can be bought or sold, while the expiration date is the date by which the option must be exercised. Option premium. The price of an option is known as the option premium, and it is influenced by a number of factors including the current price of the underlying asset, the strike price, the time until expiration, and the volatility of the underlying asset. Options trading strategies. There are a number of options trading strategies that traders can use depending on their investment goals and risk tolerance. Some of the most common strategies include covered call. This strategy involves selling a call option on an underlying asset that the trader already owns. This can provide additional income but also limits potential gains on the underlying asset. Protective put. This strategy involves buying a put option on an underlying asset that the trader owns. This can protect against potential losses but also adds to the overall cost of the investment. Straddle. This strategy involves buying both a call option and a put option on the same underlying asset at the same strike price and expiration date. This can profit if the underlying asset moves significantly in either direction, but also requires a large price movement to be profitable. Butterfly. This strategy involves buying both a call option and a put option on the same underlying asset at different strike prices and the same expiration date. This can profit if the underlying asset remains within a certain price range but also limits potential gains. Risks of option trading. While option trading can provide opportunities for profits, it also involves significant risks. Options can expire worthless, meaning the trader loses the entire premium paid for the option. Additionally, options can be complex and difficult to understand, particularly for beginners. Conclusion. Option trading can be a useful tool for investors looking to hedge their portfolio or speculate on market movements. However, it's important for beginners to understand the basics of options trading and the risks involved before making any investments. Traders should carefully consider their investment goals and risk tolerance before entering the options market, and should consult with a financial advisor if needed.